Assalamualaikum warahmatullahi wabarakatuh. Good morning, Pak Zikri. My name is Adhitya Gustiana Maulidan. Today, I will present my analysis of financial performance and valuation of PT United Tractors Tbk in the context of an independent commissioner to evaluate whether the company has great shareholder value. Overall, the United Tractors remain fundamentally strong, but profitability is under pressure. Due to commodity price normalization, revenue declined by 2%, while net income dropped more significantly by 24%, indicating margin compression. Profitability also weakened, with ROE declining to 14.7% and net profit margin to 11.3%. However, the balance sheet remains strong, with a debt-equity ratio of only 0.18%. From a valuation perspective, DCF results indicate that United Tractor is undervalued. This means the company is still fundamentally solid, but currently facing a commodity cycle downturn. On this slide, I will explain the company overview. United Tractor is a highly integrated company that operates across the entire mining value chain, from heavy equipment distribution to mining and mineral processing activities. Its main business segments include construction machinery, mining contracting through PAMA, coal mining, and gold and minerals. The key competitive advantage is being the exclusive distributor of Komatsu in Indonesia and having an integrated business ecosystem. In addition, the company is diversifying into renewable energy and mineral such as nickel. This means United Tractor has a very strong positioning, both operationally and strategically. On this slide, we look at the industry and macro factors affecting United Tractor's performance. The key insight that we can share is that United Tractor's performance is highly influenced by commodity cycles, especially coal prices. In 2025, coal prices declined by around 22% year-on-year, which directly pressured company margins at the same time. There is a pressure from energy transition and ESG trends, which are pushing the company to diversify into renewable energy. However, Indonesia economic growth of 5.11% still support demand for heavy equipment. This means United Tractor is positioned between commodity cycle pressure and long-term growth opportunity. If we're looking at the 2021 to 2025 trend, we can see that the profit peaked in 2022 and 2023, but afterward it declined significantly. Revenue remained relatively stable, but net income dropped sharply. This indicates strong operating leverage to commodity prices in 2025. Revenue was 131.3 trillion and net income was 14.8 trillion. This means United Tractor profit is highly sensitive to coal price movement. From a financial ratio perspective, all profitability metrics show a declining trend. ROE declined from 26% to 14.7%, mainly driven by margin compression rather than leverage. However, the financial structure remains strong with a low DE ratio of 0.18 and a current ratio of 1.4, indicating adequate liquidity. Through DuPont analysis, we can see that the decline in ROE isn't driven by leverage, but instead by margin compression. Net profit margin declined significantly while asset turnover remains stable, and the equity multiplier is low, indicating no resilience on leverage. This means the issue is operational rather than structural. We analyze revenue contribution by segment, and the key that we can see is that diversification is progressing, but dependence on coal remains significant. Mining contracting is the largest contributor, accounting for around 41% of total revenue, followed by construction machinery and coal mining. Interestingly, gold and minerals grew significantly by 41% year-on-year. This means diversification is working. However, around 60% of revenue still depends on coal-related business. I will explain the assumption used for the forecast. The approach is conservative assuming normalization rather than aggressive growth. Revenue is projected to grow at 6% annually. EBIT margin is assumed to return to the historical average of around 20%. CapEx and working capital are assumed to be stable. This means the model reflect gradual recovery rather than over-optimism. If you look at the WACC calculation, unit tractors is around 8.8%, and the key point is that WACC is mainly driven by the cost of equity because the company has low leverage. The cost of equity is calculated using the cost of equity with a beta around 1.1. This means the discount rate reflects market risk rather than financial risk. This slide presents the core valuation result. The intrinsic value of United Tractor is estimated at 77,184 per share compared to the market price of 31,050 rupiah. This implies an upside of around 149%. However, it is important to note that the CF assumption may be more optimistic than the market. Therefore, the interpretation should be cautious. We present the sensitivity analysis. The objective is to test how robust the valuation is under the different assumptions for WACC and terminal growth. The results show that all scenarios still produce valuations above the market price, even in a conservative case. The intrinsic value is around 54,600 rupiah. This means the undervaluation conclusion is quite robust. And then we compare the United Tractor valuation with its peer. United Tractor trades at a price to earnings share ratio of 7.63 times, significantly below the sector average of around 14 times. This suggests that the market is pricing in commodity cycle risk comparison with Indica or ENDY. Also show that United Tractor valuation is relatively reasonable, and this means the United Tractor isn't undervalued due to weakness, but due to market risk perception. So, in conclusion, United Tractor has strong fundamentals and an attractive valuation. However, the upside depends heavily on commodity price recovery, and my recommendation is to accumulate or buy on weakness. So that's all from me. Thank you very much, Pak Zikri, and I will be happy to take any feedback from you. Assalamualaikum warahmatullahi wabarakatuh.